Let's calculate the stock price for Lululemon. First, we need the market cap, which is 40.15 billion. Then we need a stock price, which is 308.38. And now we can figure out the shares outstanding because it's the market cap divided by the stock price gives you the shares outstanding, 130 million. So the best way to calculate the stock price for a company is to estimate the future free cash flows and then discount that number back to today. That's what we're going to do in this video. And when we get the value of the company, we're going to divide it by the shares outstanding to get the stock price. And we're going to compare it to the actual stock price to see whether it's a buy or sell. Now let's go to the Yahoo Finance and financials and a cash flow statement and pull the free cash flow. Okay, and next we're going to get the net income, and that's on the income statement. And we use 4 years of financial data in the model. And last, we're going to take the revenue, which is also in the income statement. And take a quick glance at the numbers to make sure they look right, and also to see if there's any outliers. It's good to see a nice steady increase in revenue each year. Same thing with net income. And everything is positive, so all good signs so far. So Lululemon doesn't have any debt, which is a great sign for a company. So we're going to skip the debt section because we need to figure out the capital structure of the company so we know what to discount the future cash flows by. So let's figure out the cost of equity. We go to the Yahoo Finance to get the beta. Beta 0.96, so it's a little less volatile than a market, so it's a pretty good beta. And 9.69% is the cost of equity, and we figured that out using the capital asset pricing model. And that's what we consider the weighted average cost of capital, and that's what we're going to discount future cash flows by. So we calculated 4 years of free cash flow, and then we discounted that number back to today's values, which is down here. And the sum of the value of the company is $20.7 billion. And when you divide that by 130 million shares, you get a stock price of $159. It's trading at 308, so it's trading at a 94% premium. So we consider this a sell. So let's look at historically. So it looks like the stock was trading at around intrinsic value last year, but it's been bid up. So more people obviously wanted to buy the stock. When that happens, the price gets pushed up. And when more people want to sell the stock, the price gets pushed down. So the value, the intrinsic value of a company, even though we calculated $159, that doesn't mean that's what people think it's worth, because apparently the market says it's worth a lot more, because people look to the future of a company, not just what they're currently generating in revenue and profit. And that's the big challenge for an analyst, is to identify the future and figure out where a company's going. It's kind of like when Amazon was losing billions of dollars a year. Who would have thought it would have been the big giant it is today? I mean, you could have guessed and gotten lucky, just like playing the lottery. You could get lucky with anything. But how do you really know? No one knows. You just got to use the financials and then use your knowledge of the market and look at other factors as well. So this is my opinion on the stock, and I hope you enjoyed it. Thanks for watching.